James Penn. I'm Head of Equity at Capital International. I'm just going to give a bit of a review of the second quarter of the year. It has been a very good 3 months for equities. We've had strong rebounds in stock markets. The US market is up 20% over the quarter. European markets are up 16% on average. The UK has lagged a little bit. It's up just under 9%. The real star of the period has been the Nasdaq index in the US, which is up 30% over the quarter and has rebounded 42% from its lows in mid-March. So given the situation still doesn't look great, what exactly has propelled this rebound? Spoke to a colleague in the office, asked him to bring in his Scrabble set because I thought it'd be useful to focus on a few acronyms that I think have driven the market in this period. So I came up with this one, FOMO, or fear of missing out, which I think many of us will be familiar with in other circumstances. Essentially, originally in March, a lot of people would have said, I don't want to be in this market, I just want to wait and see what happens. They'd have stood on the sidelines, but as equity markets have trended higher, I think a lot of people have been drawn into it in the hope or expectation, perhaps, of making gains. Another one that I think is important or illustrative of what's been going on is TINA, which would stand for there is no alternative. With government bond yields at record lows, the UK gilt yield at 30 basis points at the 10-year level, there isn't a huge amount on offer from low risk or safe assets, and essentially the equity market is the only game in town if you want to make decent returns for your long-term savings and retirement accounts. You won't score very highly from either of those two acronyms, so I did come up with another one which I think also illustrates what's been going on. This is a high scoring suggestion. It does contain though the crucial Q letter with 10 points. Liquidity. Central banks and governments around the world have injected money like we've never seen before over this period. It's been even bigger than we saw during the financial crisis 12 years ago, and it's been more timely as well. I think in the US, the combined fiscal and monetary stimulus has amounted to about 30% of the entire US economy's GDP or value. That's through a combination of quantitative easing and government borrowing and increased budget deficits and handouts essentially to individuals and businesses. So that perhaps gives some indication of why markets have rebounded so quickly over this period. It's worth dwelling now a little bit on how we think markets are going to behave during the current quarter, the third quarter. Again, I resorted to the Scrabble board, and I think a lot will depend on what happens with COVID, another quite high scoring name. The recent evidence has generally been pretty good. Certainly in Europe, we've seen declining infection rates and mortality rates. There have been spikes in other parts of the world, like Brazil, and a bit of a bounce in Australia and India. It has been more worrying that we've seen a bit of a resurgence in the United States, particularly for the larger states, the likes of California, Texas, Arizona, which have all imposed or reimposed local lockdowns. Hopefully those will be enough to prevent the problem once again re-emerging into a national problem. Looking at the UK specifically, the negotiations we're currently having with the European Union with respect to what is going to happen on the Brexit front. As most people are probably aware, we're currently in a transition period which ends at the end of this year. We have formally left, but the transition period kicked in for 9 months, during which time the usual regulations apply, and we're still under the we're still operating on a free trade basis. The UK government did not ask for an extension to the transition period at the end of June, so it is almost certain that we will leave the current free trade position by the end of the year. That in effect means there's only about 2.5 months in which to agree a new free trade agreement, if there is to be one. In other words, July, the rest of July, August, and perhaps half of September. It's almost inconceivable that the government would leave it any longer than that, because it would need to prepare for a no-deal arrangement or trading on WTO terms, if that is to be the case, without some possibility of preparing for that. And I think the UK would need perhaps 2 to 3 months in order to be able to do that. So we do have 2.5 months to come up with a deal. Hopefully we will. The more recent signs have been quite positive on that front, but there are still quite a lot of risks. In summary then, the global economy is currently rebounding. It contracted 6% in the first quarter, it contracted another 8% expected in the second quarter. We are past the worst, we're past the trough. The global economy is now growing once again. But there's still a long way to go. And we do have other risks, like the possibility of a second wave of COVID-19, perhaps later in the year, perhaps in the autumn or in the winter. We do also face a possible risk of a no deal withdrawal from the EU and trading on WTO terms, which would cause some disruption. In summary then, I think it's fair to say that any equity market gains, if there are to be gains over the current quarter, the third quarter, are likely to be more muted than we saw in the second quarter of the year.